Hi, this is Alex Fensky, the lead agent for the Chicago Southland Homes team at Keller Williams Realty, and I am here with you today for the October 2023 housing market update. We're going to go through a bunch of different important real estate metrics and what they mean to you wherever possible. I might try to predict the future a little bit, and I have a told you so moment in the content today where I was right. I always like it when I get to be right about a prediction that I made, but it's more of an observation than a prediction anyway. There are probably three really important changes that we're observing now that have just happened. One relates to pricing, one relates to demand, and one relates to mortgage rates. So stay tuned, buckle up, and we're going to get going. We're going to start out with looking at some supply metrics, what's happening with sellers in the marketplace. So right here, what I've got pulled up is our chart that's showing that new listings in the month of September were down 19% compared to September of last year. So we were at about 13,000 new listings entered in this September compared to a little over 16,000 last year. If I zoom out, you'll see that this is the lowest September on record by far. There is not a September dating back to at least 2008 where there have been fewer homes placed on the market. A lot of buyers are probably feeling that, and it can differ, of course, from place to place. But more importantly, is the seasonal trends are a little disrupted. You know, as I click through these right now, you're looking at a 3-year chart, so you can see there's a pretty regular, even after this little hiccup here in early 2020, something happened. I can't remember what it was. There's a pretty regular cycle to when new listings come on the market, and it goes up and down and up and down and then up and nope. It did not go up. It just broke and went down. It's not supposed to happen this time of year. So that's something that's unique about this year. And a related metric that we look at, that's new listings. Let's also look at the total number of homes for sale. Now, here's the total number of homes for sale. Again, another seasonal trend that normally looks like these, you'll back it out to a 10-year chart. Other than that funky year there with COVID, it's a very regular trend. Up and down, up and down, up and down, very regular intervals until up and down, and not up again. The number of homes currently on the market is actually just about the same as it was in January. And by this time of year, normally there's 30% more homes for sale than there were in January. So that is a difference that is unique to this year. That's not happened in years past. Actually, it's right now you're looking at this almost 32% fewer homes for sale than there were in September of last year, and we are still hovering around these rock bottom inventory levels. We got a long way to go to get back up to where inventory would be considered normal. So that's the supply side, down a lot, record lows, flying in the face of seasonal norms. What's going on with demand on the buy side? So we'll start with pending contracts. This is one of the big changes that I'm seeing right now. Pending contracts you see are down 1.8% compared to last September. So down, but just a tiny bit. And in fact, the last few months, we've been seeing that the gap in the year-over-year drops in pending contracts it's been narrowing, it's been closing. And so we've had, since November of 2021, demand has basically been on a steady and fairly fast decline. And as of right now, it looks like that has probably ended. Right now, you're looking at a monthly metric, so it's showing you a data point for each month, how many pending contracts were there at the end of the month. But that, of course, as you can see, follows seasonal patterns. When we want to eliminate seasonal patterns, we would go to a rolling 12-month average. And I'm going to back this out to a 5-year chart. So here we were, going along nice and steady. All right, there's a pretty steady number of pending contracts. COVID happened, world shuts down, world opens back up, housing needs change, and pending contracts absolutely skyrocketed, peaking. I got to move myself a little bit. Peaking in May of 2021. They dropped a little bit and they kind of stabilized, but then starting in November 21, it was roller coaster down. And so demand has been dropping since then. But do you see this little right down here? It's flat. I've been telling you for 3 months, it looks like it's starting to flatten out, and it is starting to flatten out. So the drop in demand is basically looking to be flattening out. Now, whether that continues or not is going to depend on a lot of things, but that's where we've gotten to right now. We also want to look at closed sales, but keep in mind that closed sales as a metric is going to lag pending contracts in terms of reporting, which we do on a monthly basis, by probably 2 months, because it takes a pending contract that 1 or 2 months later is going to close. So closed sales, we have not seen the same flattening. We have not seen the same flattening yet. Say that 3 times fast. Closed sales in September were down 21% over last year, and that 12-month rolling average curve hasn't flattened yet. But I suspect in the next month or two, you'll see that start to happen, just based on what's happened the last 2 months in pending contracts. So that's one big change is demand. The drops in demand appear to have stopped, appear to have flattened out for now. We looked at supply, we looked at demand. Now let's look at how the two intermix, because we can't look at them in a vacuum. 2 metrics I look at here. Number one, months of housing supply. And let me back this chart out. We'll look at a 5-year chart. This is months of housing supply. It tells us that if buyers kept buying at the pace they're buying, and theoretically, if no new listings came on the market, we're just looking at the available inventory, how many months would it take for buyers to buy up all the existing inventory? And the line where a balanced market would be somewhere up off the top of this computer screen at 6 months. You can see here the top of this chart is 4.5 months. You can also see here that supply has essentially not changed since late 2021. It's been 2 years, and supply has been bouncing around between 1.7 to 1.9 months of supply. It's very, very much a seller's market. And at this point, we've had under 6 months or shorter than 6 months of housing supply since October of 2013. It's been 10 full years that we've been in a seller market. That is a long market cycle, and it almost begins to feel more like an era than a market cycle, especially when you start to consider what's going to need to happen for that to come back up. We're a long way from 6 months. We're at 1.8 months. And even though demand dropped off by a quarter or more, you saw that demand chart, it just plummeted. Even despite that, because of the limits in seller activity, supply hasn't changed. And so when do we expect to see this go back up towards a balanced market? And what's going to cause it to do that? Whatever it is beyond me. I don't know. But unless there's something really drastic that happens, really drastic, it's going to take probably a long time. And what we see now is a 10-year seller's market may become a 12, 13, 14, 15-year seller's market. I'm not sure. That future, I will not try to predict. But that's a really important metric to watch, and explains a lot about how the market feels to someone who's participating in it. One other metric on the supply-demand relationship, we'll look at days to contract. And let me zoom back in for you here. Our median days to contract still clocking in at 10, has not changed since about the same time frame. So housing supply and market times are going to be related. And this has really been at or below 10 since July of 2021. So it is the seemingly perpetual seller's market that we're in right now. And it may be quite a while yet before that changes. I know you're always looking to hear what's going on with prices. Check it out. This is another huge turning point. You see that last little part of the graphic right there? It's the first time that a 12-month rolling average pricing metric, meaning our seasonalized pricing, has gone up in a year. It hadn't gone up since all the way back here last August. And even then, I mean, that was by a few $100s. So really, if you look at it prior to last August, it's been a year. Prices have been flat, completely flat. And I told you, this was my prediction. I was right. I said we're starting to see that trend reverse a little bit. And I bet we're going to see the seasonally adjusted prices start to come back up. Sure enough, here it is. In fact, if you look at just September pricing compared to the prior September, it was up 7.1%. Well, August was up over last August by 7.6%. That's 2 months in a row where the same month compared to last year was more than 7% higher prices. Now, keep that in mind. when I talk about my next point here, which is mortgage rates. We just said how prices are 7% higher than they were the last 2 months. And that is despite, my gosh, these numbers have changed again since just earlier today. The 30-year fixed rate mortgage is at 7.72%. Mortgage rates have not dipped below 7% in the last 60 days at all. And yet in that time frame, prices have actually begun to rise again, despite rates being higher than they've been for any time frame. Going back to, I had to go look back, it's been over 20 years where there's been any 60-day stretch where mortgage rates were above 7%. It's like 2000 when that happened last time. So your 30-year fixed is currently averaging 7.72. Earlier today it was at 7.61. And so let me scoot this chart in a little bit to show you just this year. You can see this year rates have been on a steady climb. They were bouncing around in the mid to low sixes at the beginning of the year. And now here they're up over 7.5, and they crossed that 7% threshold right around the beginning, late July, beginning August, and they have not looked back. And despite that, prices are going back up again. So that is really notable. If I take you back to the summary page here, you can see that your government loans, which is FHA and VA, those are trading a good amount lower, more than a half a point lower than a 30-year fixed. The jumbo loans at 7 3/4, tracking right along with the 30-year fixed. The 5-year ARMs at 7.09, and the 15-year fixed, even that is over 7%. Earlier today, that was the only one of these that started with a 6. And I guess not anymore. So I always talk about how rates are volatile and they can change daily and inside of a day. Well, there's proof. My numbers from a few hours ago are already outdated. Let's talk about the Fed. The Federal Reserve met in September, and as expected, they held their target overnight borrowing rate steady at the current range of 5.25% to 5.5%. That's the rate that banks can borrow from the Fed overnight. It's not mortgage rates, but it has an indirect effect on mortgage rates. The primary thing the Fed is still doing with rates is they're trying to tamp down inflation, because inflation has been way higher than their target for it, and it's caused a lot of problems. I don't need to tell you that. So they're still trying to cool down inflation without tanking the economy. So what they said at this last meeting is they say, well, we're holding it now, but the economic outlook, the growth recently has been stronger than expected. So we really are pretty sure we're gonna raise it again in November. They're probably going to do one more raise here. A lot of people are saying 1/4 point at their November meeting. The other thing that they're saying is that they're not thinking that they're going to drop it by much at all through all of 2024. In fact, I pulled up another chart for you to look at. Let me put myself over here for you. So this is what the Fed officials are expecting to do with mortgage rates. Look, it's like, yeah, pretty much they're going to raise them here in the last quarter this year. But then the trend for next year, you can see where the Fed officials are projecting that they're probably going to land is they might end up dropping them a little bit by, this is 2025 right here. Each series of dots is a year. So they're looking at a little bit higher at the end of the year. And by the end of next year, by the end of 2024, they're looking at the target rate still being over 5%. So the borrowing environment is probably not going to be very different a year from now than it is today, barring unexpected catastrophic stuff. That's how it's looking. Now, if you see the economy tank, then they'll drop rates. But by and large, we probably shouldn't be cheering for that or rooting for that to happen. So with all that said, final parting thoughts. What are we doing about all this? Number one, as a seller, don't get ahead of yourself. It remains to be seen whether this very recent trend of prices starting to curl back up is going to continue. We're not sure. I would be hesitant to say that, especially in light of rates for borrowing being what they are. So I still recommend pricing against active listings more than you are against closed sales. Closed sales is a little bit older data, and it's really valuable, but ultimately your competition for a buyer in the market today is against your active competition today. So we want to focus more on pricing against active listings than closed sales. And on the buy side, as you can see, Prices and rates are both rising, which takes a big dent out of your affordability. So if you're really dead set on buying a home, you should probably act quickly before another month goes by and prices are 7% higher than they were a year ago and rates are now in the high sevens. You should probably act really quickly. Or if you're planning on waiting it out, you might need to wait a real long time. I showed you that chart that shows the housing supply and how far away we are from a balanced market. I'm not sure how long it's going to be, but based on what we see now, not accounting for surprises, it's going to be years before we can expect to see something that might look like a balanced market. So if your game plan is waited out, it ain't going to be for 6 months. It might be closer to 6 years. So make a good decision, but understand that tomorrow probably doesn't bring better housing affordability. With all that said, thank you for listening in. Let us know if there's something that we can help you with, a decision that you're facing, property that you're thinking about selling, if you're looking to buy, investors, anything you've got, let us know in the Chicago Southland area and we'll help you out. Thank you, and we'll see you again next month.